Hello students, in this lecture we'll be discussing about basics of national income. So let us start. So at first we'll be studying concepts of economic territory, normal residents versus Indian citizens, national income and GDP versus GNP. So let us start. So at first let us look at the concept of economic territory. Now this is the geographical entity India. Okay, this is its geographical boundaries. But there's a difference between economic territory and geographical territory. So geographical territory administered by a government within which person, goods and capital circulate freely. This is a geographical territory. Now what is the difference between economic territory and geographical territory? So economic territory will include other things such as territorial waters and airspace. Okay. So suppose territorial water up to 12 nautical mile will be included in this. Similarly, airspace will also be included in this. Other things such as, say, if India has an embassy in Afghanistan, if we have an embassy in Afghanistan, or if we have, say, a military base in Nepal, or if we have an embassy in Bangladesh, so all the military bases which are in foreign countries and all the embassies which are in foreign countries will be included in the economic territory of India if those are Indian embassies or Indian military bases. Similarly, if there's a embassy, say embassy of Australia in New Delhi, or say embassy of South Africa in New Delhi, then that part will not be included in India's economic territory. That will be excluded. Okay, so if any foreign military base or any foreign embassy is present in our country, that part will be excluded from our economic territory. Another thing you should know is that suppose there's a flight from Kochi to, say, Dubai, and if this flight is operated by an Indian company or an Indian resident, say by Air India, then this will form part of our economic territory. But if this flight is operated by, say, Qatar Airways, then this will not form part of our economic territory because this is not operated by any resident Indian or Indian company. But this is operated by resident Indian or Indian company. Similarly, any ship or vessel operated by resident Indian which carries goods to and from India will be part of our economic territory if it is operated by resident. But if it is not operated by any resident, then it will not be part of our economic territory. Please remember this. Okay, these are important concepts. Let us see them one by one. Embassies, consulates, military bases, etc. located abroad form the part of India's economic territory. So all the embassies of India, consulates and military bases of India. Similarly, all the embassies, military bases, etc. of foreign countries in India, such as, say, of Australia or of Russia, will not be part of our economic territory. Okay? Ships, aircrafts, etc. operated by residents between two or more countries. So if it is operated by resident or any Indian entity between two or more countries, for example, Air India services between two different countries, then it will form the part of economic territory. Fishing vessels, oil and natural gas rigs, floating platforms operated by residents of country in international water. Okay. Again, if fishing vessel, oil and natural gas rigs, floating platform operated by any resident of India, then it will be part of India's economic territory. So now let us move ahead and let us see the meaning of normal residents, okay, residents and Indian citizens. What is the difference and what is their meaning? So in case of normal residents, person who ordinarily resides in a country and whose center of economic interest lies in that country. It is very important that center of economic interest lies in that country and ordinarily resides in this country is called normal resident. So in case of normal resident, Indian can be a normal resident and a foreigner can also be a normal resident. So it includes both nationals such as Indians living in India and foreigners, non-nationals living in India. Because if they are ordinarily residing in India or if the center of their economic interest is in India, then they are normal residents of India. This is the meaning of normal residents or residents. Okay. But in case of citizens, those are only those people who have Indian passport or who have Indian nationality. So it will include Indians living in India as well as outside India. Indians living in India as well as outside India. So it will include those people. Okay, but it will not include foreigners. Please remember this. Okay. Basics of national income. Let us see what national income means. National income is total value of final goods and services produced in a country within year. Okay, so you have to be very careful that this is final goods and services. You will not have to take intermediate goods and services. We'll be seeing shortly why intermediate goods are not taken. But please remember for now that final goods and services are taken. It denotes produced total values or expenditure values to produce. Okay, so what it wants to say is that it denotes the total value of produce. So whatever the total value of produce, suppose if this is a shirt and this is of 500 rupees. So this is wants to say produce total value, that what is the total value of what we have produced. Okay, or expenditure value to the produce, or how much the cost you have incurred in producing this goods. Okay, so how much cost you have incurred in producing this shirt. So it can be any of the two things, the final value of the produce or how much the cost you have incurred. Okay, it should not be actually cost, it should be cost incurred plus the taxes. We'll be seeing this, but for now you can understand that this is either the produced value, that what is the final value, or the expenditure value of the produce, that how much cost you have incurred, and plus the taxes also, the taxes you are incurring in producing this. This is how you calculate national income. Okay, we'll be seeing more about this, but this is just for a short so that you understand a base I am building now. It is total of factor incomes. So what are the factor incomes we have seen? Okay, these are wages, interest, rent, profit received from factors of production. And what are factors of production? Land, labor, capital, and enterprise. Okay, so these are factor incomes, that is wages, interest, rent, and profit we are getting from factors of production. That is, this I have written here, labor, capital, land, and enterprise of a nation. This is how it is calculated. Now there are different ways to calculate national income. Okay, GDP, GNP, NNP. Okay, NI is national income, PI is personal income, DI is disposable income, and PCI is per capita income. So we'll be seeing three here in this lecture. We'll be seeing three, that is national income by GDP method, GNP, and GNI method. Okay, and this is NDP, NNP, and NNI. Now what are this? See, GDP stands for gross and NDP stands for net domestic product. So this is net. Please don't confuse this with nominal. Nominal is a different thing. We'll be seeing this, but this is not nominal. This is net. Okay, and this is gross. So this is gross and this is net. Similarly, this is GNP, gross national product, and this is net national product. This is gross national income and net national income, GNI and NNI. Okay, so NDP is equals to GDP minus depreciation. This is the relation that you should remember, a very important relation, that net domestic product is equals to gross domestic product minus depreciation. Okay, and NNP is equals to GNP minus depreciation. So net national product is equals to gross national product minus depreciation. Similarly, GNI and NNI you can write yourself, that NNI is equals to GNI minus depreciation, where N stands for net. Please remember that N stands for net and not for nominal. Okay, so moving ahead now, another important concept is of transfer payments. Now what it wants to say is that suppose this is you and this is your brother or sister. Suppose if your brother asks you for, say, send me rupees 20,000. Okay, then he again asks you that please send me 10,000 more. And then third time he asks you, please send me 5,000 more. Now, after certain amount of time, he begins returning you. He returns to you, say, 10,000 at first installment. Okay, then he again returns 10,000 in second installment. And then in third installment, he is returning 15,000. So in 3 installments, he returned back to you your amount that you have given to him. And suppose if your salary is, say, 80,000 rupees. Now you have transferred how much to him? You have transferred him 35,000 and he has returned back to you. So first you gave him 35,000. So I'm writing it as minus 30, and then he gave back to you 35,000. Okay. So now if you leave this minus for some time, you cannot count this 35,000 that your brother has given as part of your own income. Otherwise, this cycle will keep on happening. Okay, you gave it to him, so his salary increased by 35,000, and then he gave it back to you. You are also increased by 35,000, and if this cycle continues, so what is happening? You're counting it again and again. So when you transfer payment from one person to another person, when no economic activity is happening, when you are transferring it for say some gift, for some aid or something like this, this is known as transfer payment, and this will not be calculated in any case. Okay, a similar will apply if the government is giving you any kind of say pension to a person, or any kind of some grant like this, educational grant, any grant. So this will not be counted in national income, and these are known as transfer payments, which are transferred from one person to another person. Okay, no economic activity is taking place in this case. So please remember this, that transfer payments will not be calculated. National income should consider only the factor incomes. This is what I want to say. If any economic activity is taking place, that factor incomes will be involved. That is income earned through provisions of factor of production. Okay, this should be only taken. Hence, transfer payments, that is old age pensions, educational grants, unemployment benefit, gifts, should not be included in the GDP calculation. This is very important that you should understand. Any kind of transfer payment will not be included. I hope this is clear. Similarly, remittances are also not accounted. Okay. So we'll be seeing that remittances are only taken in case of GNI, that is gross national income. But they are not accounted in case of GDP, or they are not accounted in case of GNP. We'll be seeing this. It is taken in this case. But we say generally that remittances are not taken place in case of national income. But this is true for GNI. In case of GNI, we will be seeing that remittances are accounted. Okay, they take place. We'll be seeing this in upcoming lectures, so don't worry. I'm just building base one by one. Now let us see first the difference between GDP and GNP. What is the difference? Okay, then we'll be seeing about GNI. Now suppose if this is our India, okay, if this is our country India, okay, I'm just drawing a rough map, sorry for this. I'm just drawing it for explanation. Now this is our country India. Okay, it may happen that there are Indian companies operating here like Tata, okay, Mahindra. And there are foreign companies also operating in India, like say Sony, okay, Samsung. If these companies produce goods within the economic territory of India, please remember economic territory. In case of economics, we will be talking about economic territory, not geographical territory. If they produce the goods inside economic territory of India, then it will be counted in GDP of India. So any goods produced within the economic territory of India is counted in the GDP of India. Okay, be it by a foreign country, be it by a foreign company, not country, sorry, be it by a foreign company or by an Indian company. So if it is getting produced within the economic territory of India, then it will be included in the GDP. Okay, the concept of GNP is a little bit different, but I hope you got the concept of GDP. Now, in case of GNP, what will happen is that in case of GNP, let me rub a little bit here to make space. In case of GNP, what will happen? You will include the income of Indians who are abroad, Indians or Indian company who are abroad. But you will exclude the incomes of foreign corporation or foreign nationals in India. Okay, so you will exclude this Sony company when you calculate GNP, but you will include if Tata is operating in say some African nation. If it is operating in some African nation, then it will be included in case of GNP. That is gross national product. Okay, or gross national income, one may say. Okay, so this will be included in both these cases of GNP and GNI. But since we are looking at GNP right now, so we will be focused on GNP only. GNI will be considering later. So it will be included in case of gross national product, GNP. So in case of GNP, we take Indians wherever they are, be it within India or outside India. In case of GDP, we only take the companies or the residents who are part of economic territory of India. This is the main difference. Okay, so let us see the theory now. Gross domestic product is the value of the finished domestic goods and services produced within nation's border. And here nation's borders means it is economic territory. Please remember, not geographical one, but the economic territory of the country. And it is finished. Please remember, it is finished. Intermediate we do not take. I'll be explaining it later. But for now, please understand that we are only taking finished one. GDP calculation or residents includes foreign residents within India and exclude Indian residents outside India. So it is just for all residents, as I was saying. Anyone can be there if they are in economic territory of India and if they are producing something, it will be part of GDP. But in case of GNP, is the value of all finished goods and services, again finished goods and services owned by a country's citizen. Okay, very important, a country's citizen, whether or not these goods are produced in that country. So if Tata is producing something in Africa, it will form the part of our GNP. Though it will not form the part of our GDP, but it will form the part of our GNP. This is very important. Okay. So GNP calculation, in case of GNP calculation, all the citizens, includes all Indian citizens, both inside as well as outside India, are included in case of GNP calculation. I hope this is clear. Okay. So moving ahead now, let us see scope of goods and services covered in GDP and GNP. As I was saying that only final goods are covered. So let us see why it is happening and what are the other goods which we can include. So covers final goods and does not cover intermediate goods since it leads to double accounting. Now what does it mean? Suppose if this is a cotton crop. Okay, these are some cotton crops which I am growing. Now this cotton is turned into some yarn. Okay, this cotton is turned into some yarns like this. Now this yarn is converted into some fabric like this. And this fabric is converted into some t-shirt or shirt. Okay. Now what is happening is that successively the goods is getting converted from one to another. So this is my final goods. And this can be termed as intermediate goods. Now what will happen if I calculate the values of these also? So a double accounting will take place. Suppose if this is of 10 rupees, this is of 20, this is of 50, and say this is of 100 rupees. So what will happen is that total cost, if now I calculate, total cost if I now calculate, it will be 180. So a double accounting is taking place. I am taking the cost of cotton also, yarn also, fabric also, and t-shirt also. So this leads to inflated numbers or inflated GDP. So you cannot include these ones. You will have to only include the final goods and services which are produced. Please do not include intermediate since it leads to double accounting. Because now this cotton value is included in this cotton also, in this yarn also, in this fabric also, and in this t-shirt also. Okay, so this cotton value will be included everywhere. Because the yarn manufacturer will also include the cost of cotton at which he has produced cotton. Fabric manufacturer will also include it. Okay, directly or indirectly, and t-shirt manufacturer will also include it. So this cotton will get counted many times. Similarly for this yarn and fabric, one may say. Okay, so the longer the chain, the more double counting will occur. Similarly, you can see for wheat also. So suppose for wheat, then there's flour. Okay, so flour is made and then there's bread. Like this. And if from this bread, say someone makes cake, so another thing. So that is why double accounting can occur, because this wheat price, then you will account in these three areas also. Okay. Does not include sale of second hand goods. Please remember this is very important. If you buy or sell any second hand good, okay, if you buy any electronic item, say if you buy any mobile, any camera or any second hand device, say cycle, it will not be included. But services offered on such sales are considered. So if services are offered on such sales, that will be considered, but those goods will not be considered. Okay, if suppose there's this some online platform, okay, this is say platform X, and this is one person who is selling this mobile phone, and this is another person who will be buying this mobile phone, and this is via X. So if X makes some commission, say rupees 25, X is making commission, the online platform, then this rupees 25, that the service which he is offering, okay, this will be considered part of our GDP. But this mobile phone, suppose if this mobile phone is getting sold for 5,000, second hand mobile phone, and he's selling this to this person, this will not be included. Please remember this. But this rupees 25 that this platform X is charging is part of the GDP. So second hand goods are not included, but the services which are offered on such sales are considered. Very important concept. Okay. Another thing is that if you are making something for your own consumption, if you are consuming, okay, suppose if you grow, say, wheat, okay, you grow some wheat in your farm, this is wheat, and you consume this wheat finally, okay, you are eating this wheat, you are the farmer, so this will be included. So the goods which are for self-consumption also will be included. This is another important thing. Okay, it includes even those goods that are not marketed but produced for self-consumption. For self-consumption, so if you self-consume it, it will be included. And if suppose you are, say you are a manufacturer, okay, you are a manufacturer and you manufacture some items. Say you manufacture 3 items. Okay, like this, you are manufacturing 3 items. And only 2 items get sold. Only these 2 items are sold. This item is not sold. Okay, but this non-sold item will also be included. This non-sold item will also be included in the calculation of GDP. Why? Because this is now forming a part of national stock. Because in future this can be sold. So this is forming a part of our stock and this can be sold in future. So this will be included. Even unsold inventories. Okay, unsold inventories are part of our GDP. Please remember this. Okay. So even unsold inventories are included. Even those goods that remain unsold considered as an addition to inventory/investment. So these will be included. But household help, okay, such as helping our family members, helping our elders, are not included in GDP, which is unpaid of nature. Okay, if any house help you are doing of unpaid nature, not the one which you pay to your domestic maid, but if they are doing it of unpaid nature, if it is of unpaid nature, then it will not be included. Okay, so it covers all the services which are produced within the country. Any service if which is produced in the country will be included. And as I was saying, does not include non-marketable services such as household chores or care for elderly. Will not include, but it will cover all the services which are produced, any kind of services. Okay, be it doctor, be it engineers, architects, teachers, etc. All the services will be included. So this is the scope of goods and services which are covered in GDP and GNP. Please remember this. Okay, that intermediate goods are not taken. Okay, second hand goods are not taken, but the services offered are taken. Goods which are for self-consumption also not marketed are taken. Goods that remain unsold are taken, and all services are taken. But does not include non-marketable services, okay, for which there are no charges, such as household chores or care for elderly. I hope this is clear. So now let us look at the factor cost. Okay, so factor cost, as we have already seen, factor cost is the income or the cost that you get from factors of production, that is land, labor, capital, and enterprise. Okay, so these are the 4 inputs which generate factor income. Which generate factor income: land, labor, capital, and enterprise. Okay, so to manufacture anything, this factor income will be, you will have to pay this factor income, and the amount that you will pay is factor cost. Suppose if I am manufacturing a machine X, this is a machine X which I am manufacturing. So I will have to pay some wages to my workers. I will have to pay rent on which my factory is there. Okay, I will have to pay some amount of loan. Suppose if I have taken some loan from bank, that, and I will also include some amount of profit for me, that is my enterprise. So the total cost that will occur here is the factor cost. This is the factor cost. Please remember this, that I will be paying some wages, rent, loan, profit. I will be paying also for some raw material, say. So the cost that I pay to make this machine X is my factor cost. That is paying for all the factors of production. Okay, after paying for all the factors of production, the cost which occurs is the factor cost. I hope this is clear to you. Now what will happen is that this is not the final cost. In this, you will have to include some taxes. Now government will include some tax or give me some kind of subsidy. And now this product will go to market. Now this product will go to market and this will be the market cost. This cost is the market cost. Once it has went to market, this is the market cost after including the taxes, that is plus taxes and minus subsidy. This is the market cost. So one is factor cost, which is calculated after you have paid for all the factors of production, and one is market cost, which is the cost which you calculate after adding taxes and subtracting the subsidies which government gives to you or which government takes from you. So this is the difference between factor cost and market cost. We will be seeing ahead also. So this is the thing. Okay. Factor cost refers to the cost of factors of production. So the cost which is only occurred in factors of production, that is incurred by a firm when producing goods and services. Okay. Only the cost on factors of production only. The factor cost does not include taxes / subsidies that are paid to the government, since taxes are not directly involved in production process. Okay, so taxes such as GST or say sales tax are not included because these taxes are added after the product is produced. Okay, after I am produced this machine X, now government will levy some GST and then I will be able to sell it to the market. So here at the factor cost, this is not taken. Okay, this is not taken. Please remember. Okay, now let us look at it in detail. So the difference between, let us see market price and factor cost, what it is. Factor cost is the cost of factors of production. We have seen land, labor, capital and enterprise. This is not same as cost the buyer pays, because the buyer will also pay some amount of tax, say GST or sales tax, etc. Market price is what the buyer will pay, the price at market, the price that consumers will pay for the products when they purchase it from sellers. So let us look at it diagrammatically. Suppose this is the factor cost. When you add taxes and reduce subsidy, you will get market price. Okay. Similarly, when you subtract tax and add subsidy to the market price, you will get factor cost. Now here, one thing you should remember, in case of factor cost, suppose if some raw material, suppose you are taking some coal or say steel to make this product, and if government is giving say ₹5 subsidy on this steel. Okay, this steel is of say 50 rupees, but after ₹5 subsidy, it cost you 45 rupees. So you will have to include this ₹45 in your factor cost, because the factor of production, the rate of final value, the factor of production that you're getting is at 45. So you will not take your steel as 50. So here the subsidies which are given will be included, or some taxes. Suppose there's a green tax on coal. Suppose this coal is of 100, but due to this green tax, the coal is of 150 because of some green tax of 50 rupees. So the factor of production or the factor cost for the coal will be 150 and not 100. Please remember this. So the factor cost is the cost at which you are getting the factors of production. So it will include the taxes on this side. Okay, at which you are getting the materials, but not these taxes. Not these taxes. Okay, these taxes are included when you take it to the market. So the factor cost, one may say, if for the simple term, factor cost is the cost that incurs to you to produce the goods at the factory gate. At the factory gate. The cost that is incurred to you to produce the goods at factory gate. So what is the production cost of goods when it just leaves the factory? Just leaving the factory. That is the factor cost when it is just leaving the factory. So in this, if you are getting 100 rupees steel for say 150, so you will include it 150. The factor cost will be 150 and not 100. Okay, if the coal is of 100 and if you are getting it for 150, or if the steel is of say 45 and you are getting it at 40 rupees, something like this. So you will take this 40 and 150 in your factor cost. Please remember. Okay. So I hope this is clear. Taxes charged by government will be added onto the factor price, while subsidies provided will be reduced. But these taxes and subsidy, I'm talking of this after it leaves the gate of factory. not the subsidy and taxes at which it is coming to the raw materials are coming to the factory. Okay, so this will be something. Okay, this raw materials, this is suppose factory. Let me redraw it. So if these are coming to the factory, these goods, if these goods are coming to the factory after, say, this coal is coming with some tax, so it is not saying about this tax not. The final goods, suppose if this is your machine X that you have produced, after this GST will be there. So this tax or subsidy it is talking about. Okay, while subsidies provided will be reduced. So taxes charged by the government will be added onto factor price, while subsidies, so this tax will be added, and if there's any subsidy which will be subtracted. Subsidy for this, the goods that you have produced, not the goods which you are purchasing for making this product. Please remember this. Okay. Otherwise you will do some mistake that you will say to me that, sir, you have taught to us that we do not include any subsidy or tax in case of factors of production or factor cost. So it is not like that. We will include if those are taken as inputs, not in case of the final output. So these taxes you have to include. Okay, because you cannot do anything. The factory owner cannot do anything about the tax on the coal. He will have to buy the coal at 150 rupees. He cannot negotiate with government. He will have to pay the 50 rupees carbon tax. Taxes are added because taxes are the cost that increase the price, and subsidies are reduced because subsidies compensate for factor cost. So this is the difference between factor cost and the market price. Okay. So please remember, in case of market price and factor cost, we have to add tax and subtract subsidy to the factor cost to get market price. Okay. But when you are taking goods to produce this machine X, okay, when you are taking some materials or goods, raw materials, then in that cases you will have to include those taxes or subsidy. So moving ahead, let us see the concept of factor cost. Suppose you are selling a laptop at rupees 2000. The raw material is 10,000 rupees, land is 1,000. This is labor and capital. So the total cost, that is factor cost, is 15,000. And this 5,000 is nothing but your tax. This rupees 5,000 is your tax. I hope this is clear to you how you have to calculate. Now let us see another methods, relationship between GDP at market price and GDP at factor cost. We'll be seeing the relation. So you should know about two things, that is the basic price and the market price. The basic price is factor cost, that is the cost of factors of production, plus production taxes minus production subsidy. Now this production taxes and production subsidy, what it is? Suppose if this is your factory, and if you are paying, suppose land tax as rupees 10,000, and this is your machine X. This machine X is, you are producing this for say 100 rupees and you are paying 10% GST. So the market price is 110. So now here this land tax is what? Your production tax, because it will apply on the whole factory. This land tax of rupees 10,000 is nothing but your production tax, this one, because this will apply on the whole factory. But this 10% GST which is here, this is just applying on a single product, machine X. Every machine will attract 10% GST. So this is what? Product tax. So this 10% is your product tax. This is your product tax. Okay. So please remember that basic price is factor cost plus production taxes minus production subsidy, and market price is basic price plus product tax minus product subsidy. This is very important. This is the difference between basic price and market price, that one has production taxes and one has product taxes. Okay, I hope this is clear. So GDP at market price is equals to GVA at basic price, that is gross value addition. This is GVA, means gross value addition at basic prices, plus product taxes minus product subsidies. Similarly, GVA at factor cost plus production taxes plus production taxes less production subsidies is equals to GVA at basic price. This will be there. Okay, I hope this is clear. So in next lecture, we'll be looking at methods for calculation of GDP and nominal versus real GDP. So very thank you for this lecture.